Joining our conversation now, I'm pleased to say, is Cinthia Murphy. She is investment strategist over at TMX Vetify. Cynthia, as Eric was just walking through, the flow picture has been fascinating this year. And right now, stocks are ripping. We know that could change on a dime, depending on what we hear from this White House. And given that headline risk is so high in this market, both positive and negative, what trends have you noticed when it comes to the flow traffic?
You know, I think Eric captured it perfectly when he said mixed bag. It's been a mixed bag this year. I think the flows into your traditional core portfolio holdings have been so strong. It suggests to me, both on the fixed income and the equity side, that folks are just trying to go back to the basics. Let's figure out how to manage risk 101 and build like a good, strong portfolio that can withstand for the long term. Because to your point, Katie, everything is changing on a dime. Every day is a new story, and the market can turn a 180 as quickly as we can blink. So I think that's been one big trend. Now, in the second quarter specifically, up until today, we had seen this tilt towards defensives. We've seen a lot of money go into fixed income. The conversation has been a lot about locking in that income and protecting capital. So it's been like, you know, a day doesn't make a trend, but here we are today. It's the opposite story.
Absolutely. So I want to go back to that idea of going back to basics. What does that look like, at least within equities and flows? What are you seeing?
I think, you know, the VOOs take your low-cost beta is very powerful right now. Your large cap low-cost beta, your traditional own the U.S., be bullish in the long term, without frills, without whistles, and paying as little as you can for it. That's typically very core holding. In the fixed income space, we've seen a lot of that parking into cash-like instruments, which would be your SGOV, your ultra-short fixed income ETFs. But we have seen things like TLT, BND, FBND from Fidelity, these funds that, you know, are just your aggregate, because folks aren't exactly sure what to do about the fixed income allocation. We just had a symposium last week at Vetify on income investing, and it's a little bit of everything. Folks are definitely duration, nobody wants to touch it, but everything else, they're trying to find where's the place to go. So there's just that kind of, let's keep things resilient, let's keep things conservative here with an eye on the long term, because we don't know what happens tomorrow.
Cinthia, you bring up this great point, duration. We wrote a note looking at how Bill or SGOV, which is 1 to 3 month treasuries, gave you just as much as the ag without the duration risk. And this is going back years at this point. Do you think we're going to see a permanent move out of the ag as the sort of staple for everybody's 40 and the 60-40 into, say, short duration stuff and or buffers?
You know, Eric, what I think is interesting is that I think the appetite for active management within fixed income give us a clue as to the idea that maybe there's better ways to think about an aggregate type of exposure. So we've seen a lot of money go into things like the category I think of as the flexible income category. So it's these active managers that go anywhere, but they're basically aggregate portfolios that are trying to be more nimble and be, you know, savvier with duration and with credit risk and interest rate risk. I think like at Vetify, we just acquired the Credit Suisse fixed income indices, which is also this effort to take these cues from the active management space, what's working so well, and build better benchmarks that will work for kind of the aggregate for portfolios across the board. So I think there might be a reinvention of what the ag looks like going forward, because active has done so well in the fixed income space.
I gotta say, Eric, you have an axe to grind against the ag.
I do. I just think based on what people are trying to accomplish, there's just better ways to do it with less of the baggage.
Baggage. We'll have to explore that later, but Cinthia, while we still have you, I do want to talk a little bit about launches, because the product press has been really pumping this year. Eric points out that you think about the pace of launches, it's up 50% year over year. We're on pace to see 1,000 new products launched in 2025. It's been asked before, I'll ask it again, what is the saturation point here?
I would say about 1,000 ago. It's like the product launch pace. I don't know how anybody keeps up with it. I know that's our day job. But, there's, in my mind, a lot of innovation for innovation's sake. I'm not sure a lot of products are actually solving anything for investors, but it's really an industry right now that is looking for that next thing. I think we got used to things that become your blockbuster overnight success, and folks are really trying to capture that lightning in a bottle again. So it's a lot of products, and we're not even talking about the share class approval that is probably coming, which then is going to, again, double, triple the number of ETFs in the market. So it's going to get crazy if it keeps up at this pace. But I think it's just, maybe it's that realization. It took us 30 years, maybe, for a lot of folks to realize that ETFs are working. They're not going anywhere. Mutual funds are coming into the ETF space. All these narratives we've talked about for years. Maybe this is what that looks like. Now everybody wants in, and this is it. And we're just going to be looking at product launches like crazy this year.
Well, Cinthia, that's what we'll be talking about next. So thank you for the segue. That is Cinthia Murphy of TMX VettaFi. Great to spend some time with you.